Hey guys, this is John Bacaron with Family First Life Elite, VP for Elite Syndicate. I'm here to talk to you just about the differences of different types of life insurance. So there's three main types of life insurance, which is a whole life, term life, and a universal life. So let's talk first about the differences. Think of an analogy between car insurance. You have a liability and you have a comprehensive. Okay, so whole life, think of it as a comprehensive coverage. It locks you in at your age, at your health. Once you get it, it's a fixed product that'll never go up, it'll never go down. Okay. It'll also, with our policies, will last you till age 120, 121. Okay. So it really just stands for covering you your whole entire life. Now, initially, with this type of product, it's a little bit more expensive compared to a term, which I'll get into. But long term, it's actually going to be cheaper because you never have to repeat and renew your policy. Let me explain what a term is. Term stands for termination. It's a liability type coverage that covers a client on 10 years, 15 years, 20, 25, 30 years. You get a lot of coverage for a little bit of a price with the catch of needing to pass away during that specific period of term. So when should you use a whole life compared to a term life? An average example would be if you're looking for a solution to take care of your final expenses, you never know when you're going to pass away. So you would want to have a whole life coverage. Okay. We have a lot of plans with our company and our carriers that are simplified to issue whole life, meaning that you don't have to worry about physical exams, blood, or urine. You get approved on the spot. Once you're in, first premium payments made, your effective coverage immediately. Then we have the term policies. Typically, the purpose of a term is to cover a small period of liability. Here's an example. At 31, I had a baby. Okay, so I figured, let me get a 20-year term that's going to give me a lot of coverage for a little bit of a price to cover my liability period of raising the child until the child's an adult. So I figured, let me get $1 million policy. I'm going to cover myself. In case I pass away before the baby turns 20, there's $1 million coverage for my daughter. Now, ideally, if the term expires, so will my responsibility on her because at 20 years old, now she can take care of herself, she can get a job, she can be on her own. Okay. We also have a need for mortgage protection or income education for the kids, for children's college education. So that's where the term will come in. The idea is we cover a 30-year mortgage, whether we do a fully underwritten application, a level term, or a return of premium term. That'll cover the house balance until the house is paid off. But the idea is the term will disappear because the house need or the house balance and the mortgage is paid off. Lastly, I want to explain a little bit of information about universal life. So it's a combination of a whole life and a term life meant more for investments or a permanent death benefit solution. This is typically the best solution for clients that are self-employed, that are looking to add to their retirement, where they can overfund the policy. It builds a higher and stronger cash value that's typically indexed in the market and the S&P 500, which allows higher gains on the cash value, which then you're able to borrow later in a point of stage in life as far as retirement as a tax-free retirement. So if you guys have any questions, feel free to reach out to us. My name is John Bacaron. Thank you.